But what we've seen in these low interest rate environments over the past handful of years, and the volatility associated with bonds and interest rate environments, bonds can also lose value. So the traditional 50-50 portfolio that people would use or be their go-to in retirement, those can also cause a lot of stress and can also be very risky, even though you're in a balanced asset allocation. And we saw that just in 2022 when equities and bonds were both down and a lot of people's portfolios were significantly in the red. So when you think about positioning the fixed indexed annuity into your overall retirement plan, you really want to think about that FIA as a bond alternative, which we've discussed in previous episodes. You should be positioning that over there to act as a bond, but in the sense that you're shielding yourself from any downside risk that would be associated with a bond portfolio. But you're also in good years giving yourself very fair rates of return so that in the event you need income or need something down the road, you have this reserve bank that's been growing in that fixed indexed annuity that you can tap into, and you're never being forced to sell shares of a stock in a down market. So that's where that optimization comes in.
Yeah, it would be interesting to see, if somebody speaks to their advisor now, it's funny enough, I've got a call with my advisor tomorrow just to see what their opinion is now on the bond position today compared to maybe what their opinion was 10 years ago.
Yeah, and I think it's probably changed in a positive way, just because interest rates have gone up, which makes the coupon or the yield on that bond attractive. But regardless, there are alternatives to that. Not everybody wants to play that game. And that's where this fixed indexed annuity can be an optimal solution for somebody looking for alternatives. So let's talk about, the general risks, right, of relying on traditional investments. And the big problem here are these recent market crashes and how they can potentially derail your retirement. I've had people in these scenarios, like I said, I've been through these before, and I've had people where they literally have come to tears because they're being forced with options that they never envisioned when it comes to retirement. They're being forced to either work longer to hopefully get that time back on their side to recover, or they're being forced to retire with less money, which then translates to less income, which then also translates to a lesser lifestyle, maybe one that's less than what they're accustomed to and what they've worked hard to hopefully build and be able to create all those working years. And so when you look at traditional investments like stocks, bonds, even mutual funds, you're still exposing yourself to major risks, especially when it comes to these cyclical bear markets that we might be entering once again. So if you think about, where a fixed indexed annuity can help in these scenarios and help against these market downturns, it's very simple. Let's say that you take a fixed indexed annuity, right, and we're linking it to the S&P 500, the pure S&P 500. It's an index that everybody knows. It's one that's easily available to track. Inside of a fixed indexed annuity that's using an S&P 500 index strategy, oftentimes you're going to see those associated with what's called a cap rate. And that cap rate is very simple. It's the ceiling or the max that you can earn each crediting period. In this case, it's every year. The most you can earn would be that up to that cap rate. So if you have a indexed annuity with an S&P 500 with a 10% cap, if the market goes up 8%, you're going to get the full 8%. If the S&P goes up 12%, you're going to get the cap, which is 10%. But if the market goes down 20%, guess what? You lose nothing. And that's really the beauty of it. That's where understanding the mechanics and how to appropriately apply it to your plan is essential.
Yeah, I mean, I've got to speak from firsthand experience. This is my conservative or bond position, if you were to call it that. That's how I use a fixed index annuity personally. This is my bucket for safe market growth. Not concerned about the market. I mean, don't get me wrong. There's monies that I do have that are in the market, but I'm not concerned about my fixed index annuity today with what we're experiencing.
Yeah, exactly. And that's the whole point, is to not have to worry about that portion of money that's in that type of vehicle because of those contractual guarantees. And when you really think about it too, like we work with a lot of conservative investors. I mean, literally people that don't want any piece of the stock market, either because they just are risk adverse or they've been burned in the past. I've had people tell me, like, I'm the worst stock market investor of all time. Like, no matter what I touch, no matter what I buy or invest in, it never makes a dime. It just goes down. And so there's timing, right? There's always going to be timing risk that's associated with investments. And what we do know is that over long periods of time, the stock market goes up. And if you look at since the inception of the S&P 500, which was 1957, if you were to break out all of those years of returns, it's about 74, 75% of the time, the S&P is up on an annual basis. But you still have that 25% of the time when it's been down. And so if you time it wrong and you're not really spending enough time in to recover, or you're putting your monies in at the peak and then pulling out at the bottom, obviously you're not going to have a great day or experience investing in the market. But it's important to understand that, it's okay if you don't want to invest in the stock market. We work with people that are conservative, very, very conservative, where, they've still amassed a very fair amount of wealth. Because generally what comes with very conservative people is they're also great savers and they're not big spenders. And because they avoid losses, they also don't lose time, trying to recover. And what we often find is that slow and steady sometimes wins the race. And it's like the old story of the, what was it? The rabbit and the hare and the tortoise, right?
Yep.
The rabbit, is that it? Yeah. The hare and the tortoise. Yeah. And, slow and steady wins the race. And what I can tell you is that when these conservative investors find out about fixed indexed annuities and how they can still participate in these market upside, the upside growth of the markets, but not have to worry about experiencing any of the losses, it becomes a very attractive product for them because, they're used to getting very menial or lower rates of return in these very safe money investments like CDs,